Now we have some entertainment. Okay, Torsten Slok is going to give a talk. Okay, and I just want to say a couple of words. I've known Torsten a really long time. In fact, I knew him since he was a graduate student. He was my research assistant in a big project I did with Barry Eichengreen, and I spent that year at Princeton University. I had a fellowship from Peter Kennan, and it was really, he did a fantastic job, and it was great knowing Torsten. And then from there, he went to the IMF, he went into the private sector, and now he has, over the last few years, he's become probably the most prescient commentator, okay, on what's going on in the real world. So I think we're extremely lucky to have him here. I've been thinking about bringing him here a long time, so I'm going to turn the floor over to Torsten.
Thanks so much, Mike. I remember trying to simulate a model, what had happened if we had not had the gold standard was quite a challenge with you and Barry. But thanks so much for having me. So what I'm going to talk about are issues around what is the outlook for corporate finance, and specifically focusing on what is the role of private credit. And I'll make three conclusions in three different areas. First of all, we will have a look at what is the source of credit in corporate finance today. When we open our textbook, we normally think about it as there's a bank, I need some money, I walk into the bank and I get a loan, and that has an interest rate, and that's what matters. But as we all know today, the financial system has changed and evolved quite significantly, so therefore the banking sector plays a very different role relative to what it used to do. So the first few slides will focus on what are the sources of credit, what are the types of corporate finance that are happening today. Secondly, I'll turn to the role of private markets, and I'll focus on one very important issue, namely, why is it that financial markets are spending so much time on the S&P 500 when there are 6 million businesses in the US with employment? So we'll look at a few slides of what is the size of private markets and what is the size of public markets. And finally, we'll turn to a topic that we also just have discussed in several of the panels, namely, what is the impact of tariffs on corporate finance? What is the impact of all this uncertainty in terms of how companies are financing themselves? And what does that mean for how we should think about borrowing and credit? So with that little agenda, let's first turn to the first topic, namely the issue of what is the role of the banking sector in corporate finance. And what you see in this chart here is simply, I took the data from the flow of funds, or the financial accounts at the Federal Reserve as it's called, and simply divided what is bank lending divided by total lending to the corporate non-financial sector. And as you can see in this chart here, the banking sector is playing a smaller and smaller role. So this raises, of course, a lot of questions around, well, what are then the other sources of financing? And if the banking sector is playing a smaller role, how should I, when I write down a model of the financial system, how should I think about what is the role of interest rates, credit spreads, different types of collateral, different types of lending when you think about whether they are risky or non-risky? And the bottom line is, as a starting point, that the banking sector just is not what it used to be when it comes to thinking about credit to corporates. And why is that the case? Well, that's because corporates borrow in many different ways today. Here are, for example, some of the obvious or normal examples and ways of looking at how do companies borrow. Number one, of course, is bank loans. And again, in the textbook, we normally think about bank loans as something that goes back on the bank's balance sheet. And that is also the traditional term loan. It is also the traditional revolving credit facility. But nowadays, as we also know, bank loans are also bundled and sold off as loans in markets. So yes, some lending by banks ends up on bank balance sheets, but there's also some lending by banks that does not end up on bank balance sheets. That's, of course, the traditional way that we've thought about corporate credit and the traditional way we thought about borrowing. The second way, if I'm a company and I need to borrow, is, of course, I can go to bond markets. The investment-grade corporate bond market today is about $9 trillion in size. And, of course, I can do also high yield. I can also do convertibles. I can do various forms of financing. There are other places to find money if I need money for a project as a company, other than going to a bank and borrowing. Other types of borrowing for companies now moves into the space where private credit is playing a very important role. One area, of course, that gets a lot of attention is direct lending. So direct lending is that Apollo gives a loan to a company, and that has some terms, and they have some covenants associated with it. And that loan then plays out on its own as a private loan that basically is not on a bank balance sheet, is not part of corporate bond markets, but is simply just a private loan between us and the borrower. Other types of corporate finance, of course, is asset-backed lending, trade credit. You can have lease and equipment financing, hybrid instruments, and securitization. So just to say, as we all know, it is just no longer the case that companies go into the bank branch and say, I would like to borrow, and if they get a yes, it's great. If they get a no, it's too bad. There are many other ways, of course, that corporates can borrow at the moment. And the conclusion is, again, that the banking sector is just playing a much, much smaller role than what it used to do. So why is this important? Well, this is very important because if we begin to think about the structure of the US economy, most of the attention, if not all the attention in financial markets, goes towards thinking about the S&P 500 companies. There is endless news on Bloomberg, CNBC, Financial Times, all newspapers around what are the S&P 500 companies thinking about and what are they saying and what are their earnings telling us. And that is, of course, all very interesting on its own. But that completely ignores that there are 6 million businesses in the US with employment. So why do we only spend time on 500 of those? And one way of trying to assess what is the importance of all the other businesses that are not the S&P 500 companies is to try to look at employment in S&P 500 companies, which is what you see to the left, and compare that with total non-farm payrolls. So if you go in to your Bloomberg terminal or FactSet or elsewhere and ask the question, how many people work in S&P 500 companies? And the answer is, it's around 29 million. That is the global number. So remember, Coca-Cola also has workers in Canada, in Australia, in Japan, in Europe. So if you add up all workers in S&P 500 companies, you get to roughly around 30 million. But now compare that with total employment in the US, which is in round numbers around 160 million. So that immediately tells you that, yes, the S&P 500 companies are important, but it is actually only about 20% of total employment in the US. And if you begin to adjust for how many of the S&P 500 employees actually work in the US, you get that it's an even smaller number. So that's another way of saying, yes, it's correct. If I'm Apple, if I'm Coca-Cola, I can go to the market, I can issue bonds, I can also get a bank loan. But if I'm one of the 80% of the companies that are not in the S&P 500, of course, I need to finance myself differently, and that's in particular where private credit is playing a more important role. Another way of looking at that is to try to look at companies by revenue size. And this chart may come as a surprise, but the data tells you, as I've written in the title, that 87% of firms with revenues of more than $100 million are private. So this is also telling you that we have this idea of private companies, this is like small mom and pop companies, but that's actually not the case. The vast majority of companies with, again, more than 100 million in revenue are actually private. So why is this important from a macro perspective? Because private credit and private equity is beginning to play a bigger role, but we are still relatively small compared to financial markets overall. One way of looking at that is to look at this chart here that shows you at the global level, all the way to the left, this is the size of global fixed income markets. They are, at the moment, as you can see, about 141 trillion, according to the BIS. The global equity market is about 115 trillion, and the total size of the entire banking sector in the world is about 100 trillion. If I now go in and add up what is the total amount of money in private credit and in private equity, the number that you get is about 15 trillion. So often it's mentioned, for example, in private credit, that it's been growing, and today it's about 1.5 trillion, and that is a big number on its own. But the bottom line still is that financial markets more broadly, if you want to finance yourself, you can go to bond markets, you can go to equity markets, you can go many different places, but overall private markets are still a relatively small part of the overall picture when it comes to finance. And if I now take the difference in the chart I just looked at and compare that relative to where were we in 2013 compared to where we are today. So these bars now tell you what has been the growth rate of different parts of the financial system. You will see to the left that global fixed income markets are about $50 trillion higher, global equity markets about $50 trillion higher, and the banking sector is about $40 trillion higher. And global private markets are about $10 trillion higher. So yes, it gets a lot of attention, all the growth that you're seeing in private markets, but private markets have actually grown in dollar terms much, much less relative to other sources of financing. So the conclusion is, well, of course, private credit and private equity is indeed growing, and it's growing quickly in percentage terms, but it's actually growing relatively slowly when you compare it to, in dollar terms, what's going on in other parts of finance. So if you are a company and you need to get financed in some way or another, yes, private credit is one option, and it is growing quickly in percentage terms relative to where we were 10 years ago, but the biggest growth in dollar terms continues to have been in other types of financing. And let me now finally turn to the last point, namely discuss what have tariffs meant for corporate finance. And here, of course, we have some different ways where we can try to figure out what is uncertainty at the moment. And we have the important measure done by Baker, Bloom, and Davis, which, of course, we also just talked about in the previous panel. And that is what you see here in the blue line. And remember, the measure of policy uncertainty includes literally a number of different policy areas, and as an attempt to try to ask the question, how much uncertainty is there at the moment about policy, and what is the discussion around policy topics at the moment relative to where we have been before? And the chart here, of course, speaks very clearly that the level of uncertainty in the blue line is, of course, extremely elevated. And this is not only trade policy, this is, of course, also a lot of other policy areas. So one way of trying to think about what is the impact of uncertainty on corporate finance is, and admittedly, this is an embarrassingly simple chart, but just to compare that with what we have in the green line, namely the corporate bond spread. And I do appreciate that it doesn't work in correlation all the time, always going back in history, but it has opened up a gap here where you begin to think about, well, given the uncertainty that we're facing, why are credit spreads not wider? Why are people not more worried about the downside risk to equities? Why are people not more worried about credit spreads potentially have to widen out a lot more? So one way of looking at this in the language of what's going on at the moment is that the blue line could be viewed as the soft data. This is the conversation in financial markets about, well, what will happen with trade policy? Is it going to remain at these levels? Is it going to go down? For which countries will it go down? And that soft data is very different from what you see in the green line, which could be interpreted as the hard data. Because everyone would tell you that the last earnings season was actually okay. So if the last earnings season was okay, well, maybe credit spreads should not be widened that much. And if credit spreads shouldn't widen that much, well, maybe then, okay, we can justify where credit spreads are at the moment. But the risk, of course, is that this could begin to spread if uncertainty stays at these levels. So what people try to do is to do impulse response functions literally between these variables and various combinations, trying to figure out if I give a shock to uncertainty, and in particular if that shock persists, what is the consequence then for credit spreads? Likewise, you could also try on real economic variables. What are the consequences for unemployment, for GDP growth, for inflation? And the conclusion, of course, is that no matter how you design your model, you come to the conclusion that if uncertainty persists at these levels, it will, of course, begin to have significant consequences. And one way that this has shown up in the more recent forecast from the consensus is that people are beginning to basically pencil in stagflation. And you see that in this chart here. This is going into your Bloomberg terminal and looking at the survey of forecasters every single month and asking the question, what is the consensus predicting that inflation will be in 2025? And what's the consensus predicting that GDP will be in 2025? And for a long time, starting in 2023, this was a relatively boring outlook. The consensus was saying, yeah, GDP will be moving basically sideways, as you can see, at around 2%, and inflation will also be moving sideways at around 2%. But then, of course, in the last few weeks, and in particular, of course, starting in March, if we take our textbook out, this is exactly what we should expect. A trade war is exactly stagflation, namely higher inflation and, of course, lower growth. So that's, of course, also implying that now, from a corporate finance perspective, we need to think about how is the Fed going to respond to this. Higher inflation says the Fed should be hiking, but weaker growth says the Fed should be cutting. So which one is it? And will the Fed put more weight on the slowing growth, or will the Fed put more weight on inflation going up? Thankfully, the dot plot is revealing what the Fed will do. Namely, the dot plot is saying that the next move from the Fed will be rates are going lower. So this, of course, opens up a lot of quantifications in terms of, well, but are we sure that inflation will be under control? So as we all know in this room, there are various quantifications from the Yale Budget Lab, from the Penn Wharton Budget Model, from the Tax Foundation, from the Peterson Institute. They try in different forms to quantify how much will inflation go up as a result of the current level of tariffs. And on average, the estimates bring you to roughly 1 percentage point lift in inflation over the next 12 months. So if that's the case, and you look at this picture, you begin to worry that maybe inflation will now be roughly 4, maybe 4.5% by the end of this year. Can the Fed cut rates if inflation is 4%? That remains to be seen, but this, of course, is also a very important backdrop for whether corporate finance and corporate borrowing will continue to still be as benignly priced as it is at the moment. So the bottom line from this, of course, is that the macro backdrop for the trade war is indeed bringing a lot of questions to the marketplace, especially when it comes to what policies we're doing and how policies should be responding to a stagflation shock as we're seeing here at the moment. And a last point when it comes to what are the implications of the trade policy shock. Something that, of course, is also very important is to think about the liquidity in financial markets. And this chart here shows you in the green line is the broker-dealer inventory of corporate bonds. And in the blue line, you see the total size of the corporate bond market. And as you quickly can see, partly because of Dodd-Frank and other reasons, the dealer inventory is very, very low at only $30 billion. And the total stock of corporate bonds outstanding is about $10 trillion, $9 trillion in investment-grade credit, and in very round numbers, about $1 trillion in high yield. So if you divide these two numbers with each other, you can see that there is basically less than 1% in liquidity available. Why is that important? Because when we went through the first few weeks here of April, when we got a shock because of the trade war, we began to see the bid-ask spread in credit widen out, and in particular began to widen out on off-the-run bonds. Remember the corporate bond market, in this case for IG, the investment-grade corporate bond market have some bonds that are traded every day, all the time. You can easily do that if you would like to sell something. But there's also on 50% of the market that are off-the-run bonds, there is just very little liquidity. And this chart here shows you the bid-ask spread when it comes to liquid securities, which is the green line, and off-the-run bonds, which is the blue line. And as you can see, immediately when the shock hit, we began to see the bid-ask spread widen. And why is that important? Because when you think about this from a shock perspective, well, if someone suddenly would like to change their positioning in corporate bonds and there is no liquidity in public corporate bond markets, of course, you begin to see bid-ask spreads widen, and that's when you begin to see real challenges in the financial system because there basically is very little liquidity in credit markets at the moment. And this brings me to a very important conclusion that there is often a debate about, well, public markets are safe and they're always liquid. Well, as we have seen literally over the last month, that's just not the case. Liquidity began to blow out in a very significant way. And you, of course, have safe investments in public markets, but you also have risky investments in public markets. Likewise, in private markets, we also have safe investments, and we also have risky investments. So the conclusion is that the trade war, and what has been less discussed, is that the shock that we are living through at the moment is really a test of how liquid are markets for anyone who would like to turn their portfolios around? And the answer is, as you can see, that the dealer inventory is very low, meaning that if I would like to buy, let's say I'm a pension fund in Boston, I would like to sell some corporate bonds, or I'd like to buy some corporate bonds, there's just very little inventory left. And likewise, the spread that I have to pay has unfortunately widened out quite substantially. It has improved a little bit since we put this chart together, and on a daily basis, it may also on some days be better than others, but on average, it takes about 5 days to trade a specific corporate bond at the moment, and that's of course not an environment that we think about from the textbook where you have a market that's functioning very well. So with that, let me just end up by summarizing what the complications have been for corporate finance, especially also when it comes to capital markets. So yes, the macroeconomic shock of stagflation creates problems for the Fed, but what really is the most significant problem is also how we have seen significant issues with capital markets being very different today relative to before uncertainty went up because of the trade war shock. So this chart here shows you loan issuance. So think of this as loan issuance in the marketplace where banks bundle together loans and go and issue them combined either, as you can see, as repricings, refinancings, extensions, and non-refinancings. And as you can see, after Trump won the election in November, you began to see loan issuance go up. So the bars for December and January were very high. There were a lot of people who had been sitting on the fence who came to the marketplace and wanted to issue debt. And that's, of course, what you can see in this picture here. But unfortunately, after the trade war began, you can see debt issuance came down quite substantially. And this has unfortunately also been the case when you think about IPO activity. This has also been declining. And finally, you've also seen M&A activity declining. And why is it capital markets activity is so weak? Well, think about it. If you are in corporate finance, you try to build a model for the next 3 years where you think about what is the revenue for my company? What are the costs for my company? And of course, a very important part of this calculation is to try to figure out who will be buying my product. And if you don't know what the risks are, can I sell to Canada? Can I import from Mexico? Can I get imports from China? Then those risks create a much bigger standard deviation of what is actually the outcomes that we are expecting. And if I not only have a bigger standard deviation, but I also, because of stagflation, have a higher discount rate, that means that corporate finance is hit by the double whammy of, first of all, having a lot of uncertainty about what's happening with my earnings. And the second problem is I also now have uncertainty about what's happening to my discount rate. So if I go to the market, I'm a private equity fund, I would like to do an exit, and I try to have a company that I would like to sell. The challenge is that there's just so much uncertainty about not only the discount rate, which was the problem before the trade war came along, but also because of the issues around what is the profile for how much money will this company make. And that's why capital markets effectively, they are open for very high quality companies, but for the rest of the market, they are effectively shut down at the moment. And that is obviously also something that has very important implications for the business cycle. So the conclusion, of course, from this is that as long as uncertainty is high, this continues to be something that has very important implications for corporate finance. So the bottom line is, we have a very unique situation where there are some very important impacts on corporate finance, both from the structural reasons I mentioned and also from the cyclical reasons I mentioned. And finally, just the last point, let's not forget, as we also talked about in several panels, there are also other things going on that potentially could have implications for corporate finance. And one thing that, of course, could also be happening is issues around the levels of debt for the federal government. Of course, if we have a trade deficit, then, of course, the rest of the world accumulates a lot of US assets. And this chart is just here an important reminder about what is the amount of assets that the rest of the world holds. So to the left, you see total amount of US equities held by foreigners is about $18.5 trillion. So that's about 20% of the S&P 500 is owned by foreigners. You can see in the middle bar, US Treasuries, $7 trillion is held by foreigners. That's about 30% of US Treasuries outstanding. And finally, to the right, $5 trillion in corporate credit held by foreigners. That's about 30% of the credit market that foreigners own. So the conclusion now is, if we begin to talk about Mar-a-Lago or swapping treasuries with a 100-year government bond with no interest rate, it opens up a lot of conversations around, well, what are foreigners going to do? And if foreigners own as much as 20-30% of financial markets, this, of course, also begins to have important implications, in particular when we begin to talk about what it means for treasuries and what it means for the level of rates and term premium. So the bottom line, to summarize what I've said, first of all, there are some very important developments that we should not forget are happening where the banking sector plays a much smaller role, and private credit and markets are playing a bigger role. That's a structural change. This has been going on, as the first chart showed, literally for decades, and it just continues to point in a direction that banks are less and less in the business of holding loans on their books. The second thing is, of course, cyclical changes. I spoke about tariffs and stagflation. This is also, of course, something that has implications for corporate finance. It is more something that, of course, that's a cyclical development, but nevertheless something that continues to be very critical for how we think about what companies pay when they borrow at the moment. And finally, the risk to the outlook is the much broader issue of what's going on with debt and what's going on with things such as the Mar-a-Lago Accord and the administration's policies towards how we're going to deal with these challenges if we do want to build a bigger manufacturing sector. That's not something that directly impacts on a day-to-day basis, of course, what's happening from a corporate finance perspective, but it's enough to potentially be a risk that we worry about in terms of what companies have to pay when they borrow. So with that, let me stop there and turn it back to Mike, see if we have time for questions.
I think we have time for some questions.
Can you talk for a minute about the distribution of private debt, private credit, number one, US versus global? How much is this a phenomenon, where it's concentrated?
Yep.
And secondly, increasingly you see sophisticated asset managers, wealth managers, advising their clients to include private equity and private debt in their portfolio allocation. Do you have a view on that?
Yeah, so if you look at the total amount of private credit outstanding is about $1.5 trillion, and roughly $1 trillion of that is in the US. So it is mainly a US phenomenon. And there's a number of reasons for that, but one very important reason is that US financial markets, partly of course, are a lot bigger, but also because there are various other rules in other countries where it's, in some cases, can be much more difficult to do private credit. But the answer to your question is it is to a large degree mainly a US phenomenon. And the second part of your question is very important. Financial advisors are a very important client of Apollo. We have registered investment advisors, we have UBS, Morgan Stanley, and others, and absolutely a lot of our funds can be found on the shelves of financial advisors. And the idea is exactly that this gives access, democratization in terms of access to private equity and private credit. Of course, as an investor, you need to spend some time thinking about what do these different funds do, what are the differences in strategies, and a lot of the things that I talked about here become very, very important discussions, namely around, are you investing in growth companies? Are you investing in value companies? If you invest in growth companies and interest rates are higher, then of course that will have some implications. So the growth profile and the profile of what the assets are in the funds are very important aspects of this. So there is an important education part in terms of making sure that investors understand what are the different products that are on the shelf.
Any more?
Thank you. Samim Gamami from the SEC. How do you measure vulnerabilities in private credit market? And what are the current impact of uncertainties on private credit, other than the business development companies that are relatively transparent?
Yeah, so as you know, there are BDCs that are publicly traded where you, of course, can see everything that they are doing. So that gives you at least an idea on that front. I would say at the highest level, from a macroeconomic perspective, one very important dimension is this dimension about, well, if interest rates are now going to stay higher for longer because inflation is higher for longer, that then brings, of course, a lot of discussion around which types of strategies are more sensitive if interest rates are higher for longer. And the strategies that are more sensitive are obviously businesses that have no earnings, companies with low coverage ratios. That means companies that have very little earnings relative to their interest payments. So that's a different way of saying business models in areas such as software, enterprise software, life sciences, venture capital. By definition, venture capital is investing in companies with no earnings. So of course, if you have no earnings and the profile is that earnings only come after 5, 10 years, of course, those companies are going to be more vulnerable to a higher discount rate. So this one answer to your question is that one dimension that is important for assessing who is impacted by what is to try to look at what is the sensitivity. Are these companies actually some companies that have earnings or not? Another dimension is also the trade war. There are various sectors in the economy that are differently impacted by the trade war. The sectors that are significantly impacted by the trade war is consumer retail, it's energy, it's industrials, because those are businesses that generally have imports from the rest of the world. Other parts that are less impacted is, for example, healthcare, tech, media, telecom, because those are generally service sectors. So I go to the doctor, I go home again. That has nothing to do with tariffs. But in that sense, it also becomes another dimension of thinking about what are the risks in terms of who is it that's most impacted by tariffs. But I think the main answer to your question is that there really is very little difference between public and private. In the private market, something is safe, something is risky. In public markets, something is safe, something is risky. So from that perspective, it is the same thing. It's just a matter of whether you, almost with the BDCs, can see any difference between what is public and what is private. Yep.
Yeah, the stability of the IG spreads kind of makes sense in terms of perhaps those companies are most able to sustain the uncertainty. At the same time, what's happening as those spreads are stable? What's happening with borrowing costs of private companies that might be more susceptible to the risks?
Yeah, so absolutely. So the credit spectrum here, of course, at Apollo, we are also, Athene is our insurance company. And so Apollo has $800 billion AUM. And Athene is the vast majority of our assets, and 95% of the assets we have in our insurance company are investment-grade credit. There are also other strategies, to your point, and other managers, of course, who are further down in the credit spectrum. And certainly it's the case that there's been less liquidity than there has been even in the IG market here. So you're right, there are certainly liquidity issues and issues to think about in terms of what are the various parts of the credit spectrum and in terms of what are the vulnerability to bid-ask spreads widening when you do experience a shock. The good news, again, is that remember, investment grade in the public market is $9 trillion, and high yield is $1 trillion. So the investment grade market is 9 times bigger than high yield. So that means that IG is still by far the biggest part of credit markets.
There's a question there.
Yep, Mark.
Thank you, Torsten. This is Axel Merck Investments. Fascinating as always. This audience might be interested in systemic risk. And when I heard you talk about spreads, what came to mind was economic slowdown, but not systemic risk. Is in any of the work that you presented the potential for more systemic risk to the system?
So if you just compare the charts I had with the size of private markets compared to the size of bond markets, equity markets, and the banking sector, I mean, private markets are still very, very, very small. The total size of private markets, as that chart showed, was roughly around 15 trillion, and the total size of all the other markets combined is more like 400 trillion. So from that perspective, private markets still play a very, very small role. Another way of answering your question, if you go in and look at the employment report and ask the question, how many people work in commercial banks? The answer is there is 1.5 million people who work in commercial banks. How many people work combined at Apollo, Blackstone, KKR, Carlyle? It's about 15,000 people. We simply do not have the reach and the touch compared to what the corporate banking sector is doing. So that means that the total commercial banking sector has branches all across the country that, of course, are much more out there and, of course, are much, much bigger in scale than what we are in private markets. So in that sense, private markets are a much, much smaller entity relative to what you have in the rest of the financial system.
Thank you. Krishna Guha with Evercore. To what extent do you think it's realistic to look to private credit as potentially a substitute source of finance in the period ahead if elevated uncertainty makes it hard to raise capital in public markets? Should we think of this as a source of capital that can step up, or in reality, will it also be cautious and constrained for exactly the same reasons as public markets?
Yeah, so it is absolutely clear, including for the last few weeks, and I'm not saying anything confidential here, Apollo put $25 billion to work simply because there were a lot of opportunities to step in. So we view ourselves as stabilizers of the financial system. There was an opportunity, otherwise market would have adjusted much more to the downside. Another way of looking at that is the LDI crisis in the UK. We also were very active buyers at the time. We also helped stabilize the financial system. So to your question, it is absolutely the case that you want to have someone who's willing to take risk when there's distress. And that is one role that we have played, among others. But that being said, the size of what private credit and private equity is doing is still relatively small compared to the size of the other markets, as the chart was showing. So in aggregate, we're still quite small relative to, again, the hundreds of trillions of dollars of other types of financing that are available for companies.
Okay. So listen, this is fantastic. We have a lot to worry about. That's what my takeaway was. Thank you. It was really great.